Most people spend their entire lives working hard, saving, investing, and paying far too much in taxes. Not because they are careless, not because they are irresponsible, but because no one ever explained to them what I'm about to reveal to you today. There are 4 major stages in building wealth. 4 practical thresholds, where the rules of the tax game begin to change very significantly. And if you don't know where you stand, and more importantly, what you should be doing at each stage, you could be leaving tens, sometimes even hundreds of thousands of dollars on the table over time depending on your situation. So stay with me until the end, because what I'm going to share in the next 10 minutes could permanently change the way you manage your money. Hello, and welcome to the channel. Here, you won't find vague advice or generalities repeated all over the internet. The goal of this channel is to clearly explain the real mechanisms of money, investing, and wealth building, drawing on the strategies used by experienced investors, tax advisors, and wealth managers. We will explore the different levels that allow you to build true financial independence. Today we're talking about a topic people often avoid because it seems complicated: wealth taxation. But here's the truth. The big principles aren't necessarily complicated, even if the rules themselves can become complex very quickly. What's complicated is not understanding how it works and continuing to pay more than you should. In this video, I'm going to show you the 4 precise stages where your tax situation fundamentally changes, why each transition is a critical moment, and what smart investors do differently at every step. I'll also tell you the story of an investor, let's call him Marcus, whose journey perfectly illustrates each of these stages. Because in the end, it's not how much you make that matters. It's how much you keep. Let's start with the first stage, and this one is massively underestimated by most people because they think, I don't have enough money yet to worry about taxes. That's exactly the trap. When you're starting out with a net worth between $0 and $100,000, most of your income usually comes from your work. Salary, freelance work, a small business. And at this stage, the vast majority of your income is taxed as ordinary income, which is often, from a tax perspective, one of the least favorable types of income compared to long-term capital gains. In the United States, depending on your income level and tax situation, federal ordinary income tax brackets currently range roughly from about 10% to 37%, although many middle and upper income earners often fall somewhere in the 22% to 32% range. In the United Kingdom, the basic income tax rate is 20%, with a higher rate reaching 40% for some taxpayers depending on their taxable income. In Australia, marginal tax rates gradually increase as income rises, and the tax burden becomes noticeable well before reaching very high incomes, although the exact rules depend on the thresholds in force for the given year. But here's what many people don't realize at this stage. This is precisely the moment when the decisions you make can have the greatest proportional impact on your future taxes. Why? Because tax-advantaged accounts, the 401k in the United States, the Roth IRA, the ISA in the United Kingdom, the superannuation system in Australia, derive much of their power from long-term compounding. And compounding needs time to work. The earlier you start placing money into these tax-advantaged structures, the more powerful the cumulative effect can become over time. Let me give you a concrete number. If you invest the equivalent of the historical annual contribution limit, about $6,500 per year, into a Roth IRA at age 25, by age 65, assuming a hypothetical annualized return of around 7% after inflation, you could end up with roughly $1.3 million. And qualified withdrawals from a Roth IRA are generally tax-free at the federal level. All of this happens legally within the framework of the tax code. Nay, but if you wait until age 35 to start, the exact same effort produces significantly less, roughly half that amount in this type of projection. You've given up several $100,000 in future value simply by waiting 10 years. At this first stage, the lesson is simple but powerful. Maximize your tax-advantaged accounts before maximizing fully taxable accounts. even if it feels small, even if it seems symbolic. It's not symbolic at all. Marcus, whose story I'll be telling throughout this video, started exactly here. At 27 years old, a software engineer earning $75,000 a year. He didn't understand taxes yet. He was simply putting his money into a standard savings account. Then a colleague told him about the 401k with employer matching. Marcus realized he had been leaving a disguised salary increase on the table. His employer was willing to contribute 50 cents for every dollar he invested, up to 6% of his salary. In practice, that represented an extremely high immediate return on his contribution, as long as the plan rules were followed. Now this is where things start to get really interesting, and also where many investors make their most expensive mistakes. Between $100,000 and $500,000 in net worth, something fundamental begins to change in your financial structure. You now have assets generating income, dividends, capital gains, rental income perhaps. And those incomes, if you don't manage them intelligently, can stack on top of your ordinary income or increase your overall taxable income, potentially pushing you into higher tax brackets or reducing certain tax benefits. This can resemble what is sometimes called bracket creep, and it's silent, subtle, and extremely expensive if you don't see it coming. But here's the crucial point most people miss. At this stage, you gain access to tax planning strategies that didn't exist at the previous level. First, long-term capital gains. In the United States, if you hold an asset for more than 1 year before selling it, it may qualify for long-term capital gains treatment, which often has more favorable federal tax rates than ordinary income. For many investors at this level, you might move from a marginal ordinary income tax rate of around 22 to 24% to a long-term capital gains rate of 0%, 15%, or for the highest incomes, 20%, not including the potential 3.8% NIIT surtax. Yes, 0%. If your taxable income falls below certain thresholds, you may qualify for the federal 0% long-term capital gains bracket. These thresholds change regularly with inflation, so it's important to verify them each tax year rather than relying on outdated figures. This is what's called tax gain harvesting, a strategy where you intentionally realize gains during years when your income is low enough to qualify for the 0% bracket. Next is asset location. This concept is simple but transformative. Not all investments should live in the same type of account. Assets that generate a lot of taxable income, bonds, REITs, high dividend funds, ideally belong in tax-deferred accounts. Long-term growth assets, individual stocks or index ETFs, can go into taxable accounts or Roth accounts. This simple reallocation can sometimes save thousands of dollars without changing the investments themselves. At this stage, Marcus had reached a net worth of $280,000 at age 35. He had a stock portfolio, a rental property, and well-funded retirement accounts. But he had just realized his first significant capital gains and paid the tax bill without realizing he could have minimized it. His accountant explained asset location to him. The following year, Marcus restructured his portfolio. Result: about $4,200 in tax savings in the first year alone. At the third stage, something psychologically important happens. You now have enough wealth that preserving it becomes just as important, if not more important, than growing it. And from a tax perspective, you enter a zone where strategies change dramatically. First comes estate planning. In the United States, the federal estate tax exemption has been around the $13 to $14 million range per individual in recent years, although the threshold can change over time. In the United Kingdom, the standard nil rate band remains £325,000, with additional rules depending on the family situation. At this stage, smart investors start thinking about structures like trusts. A properly structured trust can sometimes help organize wealth transfers or reduce future estate tax exposure, depending on the jurisdiction and structure used. Then there are strategic gifts. In the United States, you can give up to $19,000 per person per year without using your lifetime exemption under the annual exclusion rules currently in place. If you are married and split gifts correctly, that can reach $38,000 per beneficiary per year. Over 10 years? For 2 children, that could represent $760,000 transferred outside your taxable estate if the rules are properly followed. There are also Roth conversion strategies. Many investors at this stage have large traditional IRAs, money that has never been taxed and will be fully taxed as ordinary income during withdrawals. A gradual Roth conversion strategy, converting portions during lower income years and paying tax now at a lower rate, can generate significant long-term tax savings in the right scenarios. But there is also a psychological reality I want to address directly: complexity paralysis. When wealth becomes significant, decisions become more complex. Many people, even smart, financially educated people, procrastinate because they fear making a mistake. They say, "I'll deal with it next year," and next year becomes 5 years later. The truth is that inaction is itself a decision, and it can become one of the most expensive ones. At 42, Marcus now had a net worth of $780,000. 2 children, no will, no trust. His retirement account beneficiaries hadn't been updated since his divorce. It was a ticking estate and tax problem. After working with an estate attorney and a wealth advisor, he created a revocable living trust, updated his beneficiaries, and began a 5-year Roth conversion strategy. Projected tax savings for his estate, in his scenario, more than $180,000. For a few hours of administrative work, welcome to the 4th stage. And I say welcome because here the rules of the game change again. But this time, they change dramatically in your favor if you know what you're doing. Beyond $2 million in net worth, you enter what some professionals call the tax alpha zone, the ability to generate additional returns not through riskier investments, but through superior tax planning. At this level, strategies become more sophisticated. First, qualified opportunity funds linked to qualified opportunity zones. These structures can allow deferral of certain eligible gains, with special treatment if legal requirements are met. If the investment is held long enough, the appreciation inside the fund may be excluded after 10 years, although the original deferred gain generally becomes taxable by December 31, 2026. Second, donor-advised funds, or DAFs. Imagine receiving a charitable deduction in the year of your contribution. You donate appreciated assets like stocks. Avoid immediately realizing the capital gain. To receive a charitable deduction and recommend grants to charities over time. Third, the step-up in basis rule at death. In the United States, when assets are inherited, their tax basis is adjusted to their market value at the time of death. If you bought Apple stock for $50,000 and it's worth $500,000 when you die, your heirs inherit a $500,000 basis. If they sell immediately, they generally owe no federal tax on the $450,000 of appreciation. This rule alone can justify holding highly appreciated assets for life. Fourth, and perhaps the most counterintuitive insight, borrowing can sometimes be more tax efficient than selling. This is known as the buy, borrow, die strategy. Buy assets, borrow against them rather than selling, and pass them on with a stepped-up basis. Loans are generally not considered taxable income when received. So borrowing against appreciated assets can provide liquidity without triggering a taxable event. Marcus, now 54, had crossed $2 million in net worth. His wealth included ETFs, several rental properties, and stakes in 2 small businesses. He created a donor-advised fund for charitable contributions, refinanced a credit line for liquidity without selling appreciated assets, and worked with his attorney to optimize the transfer of wealth to his children. The lesson Marcus took from his journey? I didn't earn more. I just learned how to keep more of what I earned. Now let me give you a simple framework. Every year, ask yourself 4 questions. First, Am I maximizing my tax-advantaged accounts? Second, is my asset location optimized? Third, is my estate plan up to date? Fourth, am I working with the right professionals? And here is a truth I learned the hard way. Tax optimization is not a one-time action. It is an ongoing process. Tax laws change. Your life changes. Your wealth evolves. What was optimal at 30 may be suboptimal at 45. Review your strategy every year, not once in your life, every year. I want to end with something finance books almost never talk about: the psychology behind tax planning. Why do so many people ignore these stages? Not because they lack intelligence, but because humans are naturally present, biased. Paying less tax today feels more urgent than optimizing estate transfers 20 years from now. And there's also something I call misplaced tax humility, the idea that tax planning is somehow morally questionable or only for the ultra-rich. That belief is expensive. Using legal structures available to you is not tax evasion. It's intelligent planning. The investors who achieve real financial freedom all share one common trait. They don't let complexity paralyze them. They make imperfect decisions and improve them over time. They surround themselves with good advisors. And they treat tax optimization for what it truly is: a core financial skill. Here are the 4 stages again. Stage 1, $0 to $100,000. Maximize tax-advantaged accounts immediately. Stage 2, $100,000 to $500,000. Optimize capital gains and asset location. Stage 3, $500,000 to $2 million. Focus on preservation and estate planning. Stage 4, above $2 million. Enter the tax alpha zone and the golden rule that runs through all of them. It's not how much you make, it's how much you keep. If you want to turn this video into real action, start with a simple audit of your current situation. You don't need to solve everything today, but you should at least know where you stand. Begin by identifying your actual starting point, not the one you imagine. Many people are mistaken not about their intentions, but about their starting position. Then ask yourself a very simple question. What is the most helpful next decision at my current level? Not 10 decisions. Just one, but the right one. If you're at the first level, your priority is probably to get off to a good start. If you're higher up, your priority might be to reorganize, protect, or update. The most important thing is to avoid the trap of perfection. You don't need a perfect plan from the outset. You need a living, evolving, and actually implemented plan. Well-designed taxation isn't just about paying less, it's about creating more control, more security, and often more freedom to make sound decisions. And that's also why the most financially secure people often seem calm. Their serenity doesn't come from luck, but from a clearer system than most people have. Conversely, when everything is unclear, even good income can generate stress. A lack of tax clarity doesn't just destroy value, it also destroys peace of mind. That's why taxation should be seen as an investor's skill, not a secondary administrative matter. Those who ignore it often end up underutilizing their own efforts. And if you take away just one idea from all this, remember this: true wealth isn't what you show, it's what you keep, what you control, and what remains solid when no one is looking. And of course, all of this is still education, not personalized advice. The right framework always depends on your situation, your jurisdiction, and your actual timeline. But even without knowing everything, you can already outperform 98% of people simply by becoming more intentional. Most of the benefits come from greater awareness, before they come from greater sophistication. If this video provided you with value, please take 2 seconds to support the channel. This simple act helps this type of content continue to exist and reach the right people. Subscribe if you want more content of this caliber, designed to make you more insightful, more strategic, and harder to financially trap. The real goal is to help you think more clearly, and in the comments simply tell me where you stand today. This kind of honest reflection is already a great start, because ultimately, as soon as you know where you are, you're already starting to make better decisions. Clarity almost always precedes progress. That's why major financial transformations rarely begin with a dramatic flourish. They begin with a better mental map, followed by a series of calm and consistent actions. If you understand this, you're already thinking like someone who is more financially secure, not necessarily richer today, but already harder to penalize tomorrow. Ultimately, this video isn't just about taxes, it's about clarity, structure, and the difference between being at the mercy of your money or finally starting to take control of it. And that's precisely where everything changes. The day you stop seeing taxation as a vague punishment and start seeing it as a system you can understand, organize, and use intelligently.